ಕತ್ತಲು ಆವರಿಸಿದಾಗ ಮಾತ್ರವೇ ನಮಗೆ ಮೇಣದ ಬತ್ತಿ ಬೇಕಾಗುತ್ತದೆ ಹಾಗೂ ಅದರ ನೆನಪಾಗುತ್ತದೆ. ವೆರಿ ಗುಡ್ ಈವ್ನಿಂಗ್ ಮೆಂಬರ್ಸ್. Here Rabindra Kore, chairman of Bangalore branch, wholeheartedly welcome the 52nd Jnana Dasoha live webinar from Bangalore branch. We have with us today unique personality who is taking sessions from west to south and south to Bangalore, and that is none other than CA Premlata Daga from Nagpur. On behalf of all the viewers of Bangalore branch and on behalf of managing committee members of Bangalore branch, I wholeheartedly welcome Madam Premlata Daga for the today's session. Members, the today's topic we have chosen valuation of unquoted equity shares. The madam is taking session when initially discussing. She started in Mumbai, she took session, and then SIR she also madam took session. And now the valuation is an important role where professional service is an important. So in that we thought Bangalore branch we want to invite madam. So madam readily accepted our invitation, and today she is going to enlighten all our members. So when we were saying Nagpur, we are always recalling the Vidarbha Cricket Association cricket. The Nagpur means always it is mind VCA cricket. This one now cricket is going without audience, but our Jnana Dasoha is going with audience and all the viewers, and our process of sharing knowledge is continuing. Madam, we are the first to start the webinars, and today is an 52nd webinar of Bangalore branch during this all pandemic days. And for this corona has teaches us and given one opportunity that we can easily access the member across the country and across the globe. That is the opportunity corona is given, and for sharing the expertise, people can share their knowledge without any limitations. So it is an opportunity part of the corona teaches us. So, dear members, yes, coming to an after this session, we have next our sessions will be on 25th August 2020. It is a penalty under section 271 AAD and new forms 26 AS by CA Naveen Kariwal is going to address. And after that, 26th August, we are having session from CA Prashant GS on legal issues in tax audit. And after that, on 28th August, is a 10th session of this August month. That is issues and practical aspects in tax audit by CA Deepak Chopra is going to address. For this week, this is a third session and last session, and next sessions will be starting from Bangalore branch on 25th August. So I wholeheartedly welcome all the members. Those around more than 500 members are registered, and almost now 250 have joined, and they are joining now in their absence. On behalf of managing committee members of Bangalore branch, I wholeheartedly welcome all the viewers for your active participation, and welcome all the viewers. So I request our Bangalore branch treasurer CA Divya to introduce the speaker CA Premlata Daga madam, all the our viewers. To Divya.
Thank you, Chairman. First of all, I would like to wish all the viewers and also our Chairman and also our Speaker of the Day a very happy Gaudi and Ganesha festival. To take forward, just a brief about our today's speaker, Ms. Premlata Daga. She started accountant by profession and educator by passion. She has qualified CA in the year 2012 at a very young age of 22. With her interest in company law, she went on doing company secretary course and is also member of ICSS. She even holds a diploma in information system audit, a post-qualification course on information system by Institute of Chartered Accountants of India. She is partner in MA KKS & Co. with specialization in internal control systems and business management consultancy. She started her career as an educator at a very young age of 23 with National Academy of Direct Taxes. She is one of the youngest visiting faculty at NADT and so far has taught financial accounting to 7 batches of IRS officers. She has conducted more than 500 sessions on financial investigation through Tally at NADT. And regarding her industry experience, she has a very rich industry experience and worked in many reputed CA firms and corporate entities. Regarding her achievement, she is nominated a member of Direct Tax Committee of WRC for the financial year 2018-19. She is also nominated a member of the committee of WRC for the year 2019-20. She is awarded with the Women of Substance Award 2018-19 by SheFest and Event by Times of India. She is finalist of Cerebral Beauty page in 2020 and also she has been youngest contributor of the book Investigation Techniques for Income Tax Authorities published by Central Board of Direct Taxes. With this very brief introduction, I welcome you for today's session, madam. Over to you.
Is it audible? Okay. Thank you so much, Ravindra sir and Divya madam. And I'm really, really very grateful to the Ravindra sir for giving this opportunity. Recently, I had an opportunity to interact with SIRC member and in a very short time, getting a second opportunity in one of the most, where we have so many chartered accountants, a place like Bangalore, it's always an opportunity to be a speaker for Bangalore branch. I would like to give a brief background upon what we are about to talk. We are going to talk about unquoted equity shares. And this is one of the topic which is, I guess, each and every chartered accountant, specifically those who are into practice, this topic is of utmost importance because every day we are dealing with at least few private limited companies. So this section is really a very new section, and this was amended many times, especially in 2017. So whatever I'm going to share basically is my experience, whatever I have understood. There may be some subjectivity involved. You may have a different opinion. Definitely, we will be discussing about the other aspects which probably I did not cover at the end in the Q&A session. I will try my level best to keep it to the point. Whatever questions we have, we will be taking it at the end so that we go with the flow. So I'll just share the content. I hope the screen is visible.
Yes, madam. Visible.
Yeah. All right. So let's start our journey. First, I'll take you through the sections which are relevant, what we are going to discuss today. And then we will be moving on with the complexities involved with it. So the sections that we are going to discuss today are sections 56 to 7, 56 to 7A, 56 to 7B, and section 56 to 10. Now, they are most of the people have this confusion, which section is applicable in which case. So let's first clear that confusion so that later on when we talk about these sections, we are all very clear what we are exactly talking about. So first section is 56 to 7. I guess some mic is on. All right. So first section, that is section 56 to 7. This section was introduced in the year 2009-10, that is to be very specific, on 1st October 2009. At that time, I was doing my articleship. Before these type of sections, I used to feel that there used to be a lot of gray areas and lot of planning was taking place. I just want to share one anecdote. In my articleship time, I was doing an audit of a private limited company, and that company issued some shares, and that too at a very, very high premium. Like 1 lakh shares were issued approximately at 20-25 lakhs of premium, which by common sense seems to be too high and seems to be a black money getting introduced into the company, and a tax evasion types of structure was there in that particular private limited company. Then I just happened to ask my principal sir that if we take so much of this money without any having in justification of this premium component, won't it come with some tax implication. And that day, one statement what he made was, it doesn't matter what you feel. You might be thinking that this should be taxable. But when it comes to income tax, what is important is what is written in the act. So it is extremely important. What are the sections? How they have been drafted? What are the words? In fact, I feel that chartered accountants basically have a unique skills. They basically read what is not written. So we will be also going through some of the examples, like what is not written basically, and what is written, and how the same is to be implemented. So this first section, which was introduced on 1st of October 2009, was applicable to only individuals and HUF. The government brought these amendments in stages. This was applicable for the transactions that involve money, immobile property other than immobile properties. But this section is not applicable after 31st March 2017. Then the second section, that is 7A. This section was made applicable to firms and companies. And company here include only closely held company. This section was applicable only for a transaction that involves shares of a closely held company. And it was introduced in the year 2010-11, that is on 1st June 2010. And again, this section has been done away with on 31st March 2017. So now just to talk about these two sections again, the first two sections were basically applicable whenever two individual HUF firm or a closely held company do any transactions which involve shares of a closely held company, and individual and HUF, even money, immobile property, and property other than immobile property. These two sections did not cover all the assessees. These two sections did not cover all the assets. Hence, there was an amendment made in these two sections in the year 2017, and these two sections were merged, and a new section was introduced, which is presently known as Section 56.2.10. So I repeat again, Section 56.2.7 and Section 56.2.7A are now not applicable from the financial year 17-18 onwards, and this section now has been merged with 56.2.10. 56.2.10 is applicable to all the persons defined under Section 2, subsection 31 of the Income Tax Act. This is applicable to money, immobile property, property other than immobile property. That means they have covered everybody and everything. So whenever there is a transaction that involves transfer of any of these items, and if it is not as per the valuation rules mentioned, then it is to come with a tax implication, and that will be taxed under Section 56.2.10. Though this section is very broad, we will be restricting our discussion only to the unquoted equity shares. We will not discuss about any other asset in this particular session. Then just a brief background, we will be discussing only these two sections because now these two sections are not applicable. 56.2.7b. This section is applicable to companies issuing shares. So when a closely held company is issuing shares, they are saying closely held company. They have not used the word private limited. There is a difference between closely held and a private limited company. Private limited company is also one of the closely held company. So even a limited company can come under the definition of closely held company. This is applicable when a closely held company issues shares, and this was introduced in the year 13-14, that is from 1st April 2013 onwards. So our entire discussion basically will be restricted to Section 56.2.7b in case when a company, a closely held company, is issuing shares, and 56.2.10 when the shares of a closely held company is being transferred from the existing shareholder to the prospective shareholder. So this is the broad outline within which today's discussion will be revolving. We will be talking about one more section, that is Section 50CA. I'll introduce that section later on in the discussion part. So now let's move ahead. this first section, where a company, not being a company in which the public are substantially interested, that means they are talking about closely held company, receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value shall be deemed to be the income of that company. So basically, this section is talking about when a closely held company issuing shares, and the shares are issued at a premium, provided that this clause, that these two things are an exception, provided that this clause shall not apply where the consideration for issue of shares is received by a venture capital undertaking from a venture capital company or a venture capital fund. So in case there is a closely held company which is a venture capital undertaking and that is receiving some capital from a venture capital company or a fund, then in this case section 56 to B will not apply. And second exception is by a company from a class or classes of persons as may be notified by the central government in this behalf. So there are two exceptions to this particular section. There's an explanation. For the purpose of this clause, the fair market value of the shares shall be higher of the two. I repeat, it is higher of the two. First is as may be determined in accordance with such method as may be prescribed by the government, that is Rule 11 UA, which has been so presently prescribed, and as may be substantiated by the company to the satisfaction of the assessing officer, and is higher of the two. Now, once when we the section, obviously we come up with lots of doubts because the section itself is not very clear. So let's move on to the common doubts that probably may have come up with most of you right now. So we'll discuss that in the question form. The first common doubt: is this section applicable when the amount is received from a non-resident? Is this section applicable when the amount is received from a non-resident? You can also put up your answers so that later on we can just make it a little interactive also. The answer to this question is this section is only applicable to a resident. This section is not applicable to a non-resident. I'll just take you to the previous slide again, because if you would have noticed, this section starts with from any person being a resident. That means if a closely held company is receiving the share capital from non-resident, so in that case, section 56 to 7B is not applicable. Then what is applicable in that case? In that case, RBI rules are there, FEMA rules are there. They have their own process, how the valuation is to be done, and a CA certificate is accepted there. We'll not get into it, but only thing what we need to know about, if the company is receiving shares from a non-resident, then 56 to 7B is not applicable. In that case, RBI rules are to be followed. Is this applicable to preferred shares? And the answer to this question is yes. Why? Because the word used in the section is the word share. They have not specified it to be an ordinary share or an equity share. So this section is applicable to preference shares also. Obviously, there are different valuation rules for preference shares, but 56 to 7B is applicable even if the company is issuing preference shares. So don't make a mistake there. It is applicable to both the types of shares, equity as well as preference. We will talk about preference also in brief. I will not discuss it in detail. What are the exceptions to this section that we have already seen? The provision of this section is not applicable by a venture capital undertaking from a venture company or a venture capital fund. And the second exception that we have seen is by a company from a class or classes of person as may be notified by the central government in this behalf. Obviously, with this question, we have now two more questions to ask. What are those two questions? What do you mean by venture capital undertaking, venture capital fund, and venture capital company? So every company cannot by itself declare itself as a venture capital undertaking. What will be considered as a venture capital company, fund, or an undertaking has also been defined in the Act. It is given under explanation to clause 23 FB of section 10. So if you go through section 10 and clause 23 FB, this particular definition you can find there. Only and only if your company fits into that particular definition, then only it is an exception for section 5627B. Now, one more question. Is there any central government notification stating that the provisions of section 5627B are not applicable to any particular class or classes? So yes, central government has presently issued only one notification, and that is notification number 24/2018. It was issued on 24th May 2018. And as per this notification, technically those startups which are eligible for deduction under section 80 IEC, they are an exception to section 5627 also. So if your company is eligible for that deduction which is given under section 80 IEC, if it qualifies for that particular deduction, then they are even exempted from section 5627B. So basically we have these two exceptions presently. Which are the prescribed methods for determination of fair market value of shares? So we have already seen that the government has notified a valuation method. It is given under Rule 11UA, and Rule 11UA subclause 2 has defined two methods. One is net asset value method as specified under Rule 11UA2 subclause A, or discounted cash flow method at the option of the assessee. This is very important. The method which is to be followed is at the option of the assessee and not at the assessing officer. So the company has an option. Either they can go with the net asset value method, or alternatively they can go with the DCF method, and this decision is to be taken by the company. And obviously we will talk about it, like what documents, how an assessing officer can change, and etc. That we will come up in the coming slides, where we will discuss about some important case laws. So in brief, there are two methods with which closely held companies can value their shares at the time of making fresh issue. The two methods are net asset value method and discounted cash flow method, and the option to select a method is with the company and not with the assessing officer. Now, what is that rule? That is given under Rule 11UA2. Basically, we have two rules. So you need to be very clear which rule we are talking about. This number 2 rule, 11UA is basically having two rules, Rule 1 and Rule 2. Rule 2 is applicable when the company is issuing shares, and Rule 1 is applicable when the existing shares are being sold. And the two rules are different. So we need to know what is the difference between the two rules and which rule is applicable in which case. In this particular case, fair market value of unquoted equity shares is to be calculated by using this formula, which is asset minus liability multiplied by PV divided by PE, where asset consists of book value of the assets in the balance sheet as reduced by any amount of tax paid as deduction or collection at source, or as advance tax payment as reduced by the amount of tax refund as the amount of tax claimed as a refund under the Income Tax Act, and any amount shown in the balance sheet as asset, including the unamortized amount of deferred expenditure which does not represent the value of any asset. So in short, what one thing you need to know about this particular rule is, when the company is issuing shares, at that time, the assets are required to be taken at book value. I repeat again, when the company is issuing shares and we are using the net asset value method, there is no need of revaluing your asset. The requirement of revaluation of asset is in 11 UA1, not in 2. In rule 2, they have made it very clear that we have to take the book value of asset. So even if the company wants to take the fair value of their immovable properties or any asset, they don't have that flexibility and the option available with them in case they are going with net asset value method. Second is book value of liabilities, excluding paid up share capital, amount set apart for undeclared dividend, reserve surplus, provision for tax, provision for unascertained liabilities, and contingent liabilities. So these are the common terms that we come across many times. So I'll not talk about the basic stuff here. What one thing we again need to know is, if the company is issuing shares, the assets are to be taken at the book value, and these deferred expenditure or unamortized expense, these are to be excluded. We have to exclude the advance tax, TDS, TCS paid, except if that amount has been claimed as a refund. From the liability side, we have to exclude the equity capital and the undeclared dividend part, and any unascertained or contingent liabilities. And we have to exclude the provision for taxes also. So rest of the things are simple. The only thing that most of the time we have a confusion with is whether we need to revalue the asset or not. In this case, we have to take the book value of assets. Who is authorized to issue the valuation report under DCF method for the purpose of section 5627B? Now, this was a lot of discussed topic when this amendment took place as per rule 11 UA 2B. I'll just take paid up value of such equity shares, total amount of paid up equity share as shown in the balance sheet. Basically, here we take both the shares. That means we take the total value and divide it by the total value so that we get one value. Normally, right now, we don't have equity shares which are partly paid. So here we will be taking PV and PE as the total value of the shares. We will be dividing it by the total number of equity shares to get the value of per share. And that is the price at which we will be issuing equity when the company comes with a new issue of shares. Who is authorized to issue the valuation report under DCF method? Before 24th May 2018. This date is very important because this was the day when the amendment took place. Before this date, when this notification was issued, a chartered accountant was also authorized to issue the DCF method report. But after this amendment of 24th May 2018, now a chartered accountant cannot issue a DCF method certificate. We can very much make a certificate for the net asset value method, but now only a merchant banker can issue the certificate in case the shares are issued following the discounted cash flow method of valuation. Before this date, a chartered accountant was even authorized, but after this particular amendment, now only and only a merchant banker certificate is accepted. No, this rule has mentioned it to be a merchant banker. That is how it is actually drafted. Chartered accountant, even it's qualified value or something, but they have made it very clear now accountant certificate is not accepted. Accountant has been defined in the act as chartered accountant. So now comes the important case laws. Whether the A can disregard the method adopted by the assessee and carry out the valuation of shares using a different method. I'll just share a few things here. Since I have been associated with the IRS community since last 7 years, I come across with some queries which relate to DCF method of valuation. There had been certificates in which the DCF calculation was done for issuing shares, and the projections were too high to be realistic, and that was used as a tool to introduce their black money in the form of share premium using the DCF method of valuation. So there are now confusions whether the company who has used the DCF method for issuing shares of a company, closely held company, and afterward during assessment, if in future the company's projection doesn't hold good, can the assessing officer disregard the method followed? So here we have few case laws which are very important here. In case of Innovative Payment Solutions Private Limited, the Bangalore Tribunal addressed the issue on the application of DCF methodology and the powers of the AO to inquire into it. In the said case, the assessee could not conclusively establish that the projections used for DCF valuations were prepared scientifically. The tribunal referred to a technical guide on share valuation by a research committee of the ICI, wherein it was stated that the DCF valuation is good as the assumption used in developing the projection. So the DCF basically is all dependent upon the projections that we are making. If the projection are scientific, they have some base, they are realistic, then only it is accepted. And these projections should consider various factors affecting the business. The tribunal held that if the assessee has opted for the DCF method, the AO cannot disregard it and adopt another method. However, the AO is well within his rights to examine the methodology adopted by the assessee and the underlying assumptions. And if he is not satisfied, he can challenge the same and suggest necessary modification. If your client is using the DCF method, so what is important is whatever projections we are making, the first thing, it has to be from a merchant banker, and that projection must have a basis. The projection must be realistic and must be considering the factors that affects his business. There had been, I don't remember the name, some cinema, there was some company which was into movies, and they approached angel investors like Rakesh Junjunwala and three big shots, and that company got lot of share premium from these three investors. But unfortunately, after 2 years, the company did not perform well, and the entire investment was into losses. And then department issued notices to Rakesh Junjunwala and the other two investors, saying that you have just made a book entry to claim the bogus losses and all that thing. In that, I guess it was Mumbai Tribunal, that Mumbai Tribunal said that it is not the job of the assessing officer to get into whether they should have made the investment or not. If the investments have been made based upon the assumption which sounds realistic and practical, and obviously we have to even consider who are the people who are making the investment, who are those who, I mean, what is their background, is it their money, how they are declaring, are they making investments? And you cannot question the wisdom of these angel investors, that they don't have any judgment while making an investment, because when they are making the investment, they are relying on the projections, and assessing officer is doing the assessment, he can actually see what happened in the next 2 years, which is practically not possible for the investor who has invested in the past 2 years. So basically, it's not always that the DCF method will be rejected. It is purely and purely be dependent upon the projections made, the assumptions that has been taken place, irrespective of the fact whether in future company is working as per the projections or the company did not perform well and even went into losses. So this is presently the situation. There is one more case, and this is coming from Delhi tribunal in the case of Portfolio Private Limited, it was held that since there was no possibility of verifying the correctness of the data supplied by the assessee to the merchant banker, the correctness of the result of DCF method could not be verified. Hence, the assessing officer had no option but to reject the DCF method and to go by the NAV method to determine the fair market value of the shares. So there are cases which are in favor of department, but these are the only cases where the projections are not realistic and there is no back working based on which the discounted cash flow working was made. Moving on to the next question. What are the rules for valuation of preference shares? So we have already seen that this particular section is applicable to equity as well as preference shares, but equity valuation is to be done by a different rule that we have seen right now, and preference share valuation is to be done by a different rule. Now, I don't understand why these people draft these sections in such a manner that we don't have an option but to do tax planning. Let's see how it is drafted. Rule 11.2, which is specifically applicable for valuation of shares for the purpose of section 56(2)(b), covers only unquoted equity share within its ambit. And there is no reference to the preference shares. Thus, the only method for determining the fair market value of the preference shares is Rule 11(UA)(1), clause C, subclause C, which is used herein. So I'm just going to read what is written here. Let's carefully read and then we'll just discuss how we can implement this. The fair value of unquoted shares and securities other than equity shares in a company. That means they are not talking about only preference shares. They have even included debentures and bonds also. So this 11(UA)(1)(c) and subclause C is applicable to debentures, bonds, and even preference shares. Because the word is used here is securities and not only shares, which are not listed in any recognized stock exchange, shall be estimated to be price it would fetch if sold in the open market on the valuation date, and the assessee may obtain, they have not made it compulsory, and the assessee may obtain a report from a merchant banker or an accountant in respect of which such valuation. So one thing, this is applicable to preference shares, debentures, bonds. That means all the shares and securities which are not listed on any recognized stock exchange. This rule requires that the valuation of these securities should be at an estimated price that they will fetch in an open market. Now, how a small private limited company who wants to issue preference shares will have its valuation from an open market? Who else would be interested in this? We don't know. And good thing is, they have said that you can obtain a certificate, and in this case, they have allowed a chartered accountant also. So if it's a preference shares, even if it's convertible preference shares, still a chartered accountant can issue the certificate. Even merchant banker definitely is there. Now we have a very interesting case law, and this revolves around the preference shares. How people do plannings. In case of 2M Power Health Management Services Private Limited, the assessee allotted compulsory convertible preference shares at a premium, and the holders of these preference shares had the right to attend the general meetings of the company and vote on resolutions directly affecting their interest. The tribunal held that, with regard to the facts of the case, the nature of the issued share is actually that of an equity share and not that of a preference shares. It is important to decide, based on the evidence, if the share premium received is for equity shares to be issued later or for preference shares issued right now. If the premium is mainly for conversion of preference shares into equity at a later date, then Rule 11(UA) may apply today. From the above judgment, what one can infer is, it is very important to identify the basic nature of securities being issued, and the rights attached to it, and determine the valuation methodology under Rule 11 UA. So the law evaders or the planners are basically always ahead of the lawmakers. They have defined the valuation method for unquoted equity shares, which is not applicable to preference shares. For preference shares, they have not defined any rule, but they have said that a certificate is acceptable. Now, in this particular case, what happened? We can take an hypothetical situation. A company issued preference shares, which have been given a right to convert into equity shares, and these are compulsorily convertible. That means, in the real sense, the company is issuing equity shares only, but via a preference route. So, when a company is issuing preference shares, in that case, the Rule 11 UA 1 will not apply. Sorry, the Rule 11 2 will not apply. In that case, the rule which is given under Rule C is going to apply. In this case, a chartered accountant certificate is accepted. Even a merchant banker certificate is also acceptable. They are now exclusively pan India, because whatever cases I have heard so far, these type of instruments are now being used for the tax planning. 100 rupees preference shares are being issued at 50,000 rupees premium. After issuing preference shares, in a couple of years, they get converted into equity. When they convert preference into equity, at that time, whether this rule will apply or not, because even converted at the book value in that case, there is nothing presently, in my opinion, which presently can take such type of instrument, and there is a lot of creativity involved. Compulsorily convertible, so still we can say that okay, this is 100% going to get converted into equity. What about if it's optionally convertible? A company can issue optionally convertible equity shares. At that time, we cannot say that the company is issuing equity because it is at an option. Option may be at the end of the company, maybe at the end of the receiver, I mean the shareholder. So since there are variety of preference shares, there is variety of ways how the rights of a preference shares can be designed. There is no set rule presently how it is taxed. So what is important is, whenever such type of case comes into limelight, what are the rights associated with it, why the premium is being charged, etc., is to be seen at the time of getting it taxed. This is actually very interesting. We have to wait actually for many case laws to understand how the government is going to deal with this. So this was about the case when the company is issuing shares. I'll just sum up and then we will move to the second part. When the company is issuing shares, this is applicable to all the types of shares, whether it's equity or it is preference. This is applicable only when the share is issued to a resident. For a non-resident, this particular rule is not applicable. While the company is issuing shares, the assets are to be taken at book value. They have defined two methods. One is the net asset value method, and the second is the discounted cash flow method. Before that notification of, I guess, 18th May 2018, a chartered accountant certificate was also accepted. But now, after the amendment, only a merchant banker can issue a certificate when the company is issuing shares using the discounted cash flow method. The assessing officer can disregard it and can require or can ask for the modification in the calculation part if they feel that the assumptions and the calculations and the projections are not scientific and based on the facts and figures of the business. Then they can definitely suggest the amendments in the calculation part, and can even straight away disregard it and can force them to follow the NAV method. This was all about when the company is issuing shares. Now we will be moving ahead. What happens when the existing shares are transferred? And this is the most important thing, because there had been lots of tax planning before this particular amendment. And this particular amendment also have some loopholes that we'll be discussing at the end. So let's first read this section. I won't be talking about those two sections which have been now done away with, because everything has now been merged with 56 to 10. This amendment was made in the year 2017, and this year two major amendments took place. The first amendment was by insertion of clause 10 in section 56.2 that replaced clauses 7 and 7a of section 56.2. So presently what we need to remember that as of now, only two sections are relevant. One is section 56.2(7)b that we have recently discussed, that is applicable when the company issues the shares. And the second is section 56.2(10), which is applicable when the existing shares are transferred. This section provides that receipt of money or specified property by any person for inadequate consideration or without consideration from any person shall be subject to tax. So I've covered all the persons at both the ends. Whosoever is selling the shares, whosoever is receiving the shares, that has now been that individuals, whether covered or not, that all thing has now been done away with this 56.2(10). And this section is applicable when a person receives. That means it is applicable in the hands of the buyer always. So section 56.2(10) is always and always applicable to the buyer in case he is getting shares of closely held company at a consideration which is less than the fair market value. The second amendment which took place, and the second section that we need to discuss here, is section 50CA. This is very important section. 56.2(10) is coming from other sources and 50CA is coming from capital gains. So introduction of section 50CA to provide that where consideration for transfer of shares of a company other than quoted shares is less than the fair market value of such share, the fair market value determined as per the rules shall be deemed to be the full value of consideration for computing income under the head capital gains. You might have heard about this section, and one common thing that everybody talk about it is that this section comes with double taxation. In the same transaction, when a share of closely held company is transferred at a price which is less than the fair market value, the buyer is taxed under section 56.2(10), that is under other sources, and the seller is taxed on the same amount under section 50CA. So this section comes with double taxation, which we will be discussing in detail again. What is the background of this section? Why there was a requirement to have this section? What was the tax planning? A quick background we will be discussing. Prior to introduction of section 50CA, where shares were sold by the assessee for consideration which is not in conformity with the fair market value of the shares, there was no mechanism available under the Act to substitute the full value of consideration as disclosed by the assessee by any other value for the purpose of computation of capital gains. Section 50C dealt with the transfer of capital asset being land or buildings or both, which is not applicable in case of shares. To plug this loophole, section 50CA was introduced. So before section 50CA, we already have one section which is section 50C. 50C is applicable when land and building are being transferred at a price which is less than the fair market value. But that particular section cannot be extended to the shares because they specifically relate to only land and building. The department lost many cases and ultimately they came out with an amendment in the form of section 50CA. We'll discuss about one case law to understand what people used to do. I guess it is later. Few important points that is related to section 50CA. It's applicable to all assessees. Unlike section 56.2(7)b, which is applicable only to resident, this section is applicable to all the assessee, resident, non-resident, related, unrelated. There's no bifurcation of this. Applies to all shares where equity or preference. That section also applies to all the shares. Unquoted shares should be a capital asset. This is important. If the shares are held as stock in trade, then 50CA cannot apply because section 50CA is applicable only and only to capital assets. It's not applicable with respect to gains from transfer of an interest in partnership trust, where the property of such entities consists directly or indirectly of immovable property. This is basically the gray area because they said the word shares, and share word is not defined in Income Tax Act. And if it is not defined in Income Tax Act, then we have to take its meaning from the Companies Act, where share means a share in a share capital of the company. And before getting into all these valuation part, I was of the opinion that partnership share is also a share. But that is maybe the general word how we use in the day-to-day life. But technically, a partnership share is not called as a share. It is an interest in a partnership firm. And if that interest is transferred of, or a partner is retiring or admitting anything like that, then 50CA will not apply. We will talk about this particular part again in detail with an example so that we can link it how people are exploiting this particular exclusion. It may cover even some quoted shares based on the definition. 50CA actually has defined what is the definition of quoted shares for this particular section. For the purpose of this section, quoted share means the share quoted on any recognized stock exchange with regularity from time to time, where the quotation of such share is based on current transaction made in the ordinary course of the business. So in short, what we need to know from here is that not all the quoted shares are excluded from 50CA. Quoted shares has to be quoted on some recognized stock exchange. There has to be some regularity in that transaction. So if it is not on a recognized stock exchange and the transactions are not regular, then in that case, those quoted shares can also come under the ambit of 50CA. So by default, it's a listed, we should not leave it. We have to check where it is listed, how is the frequency of the transaction, etc. Where unquoted equity shares are this is very interesting. Sometimes the income tax conflicts with its own sections. Where unquoted equity shares are contributed by a partner to a firm, the question will arise whether the provision of section 50CA would override 45(3) or vice versa. Just to tell you what is 45(3), when a partner introduces his capital in the form of an asset, then as per section 45(3), the price at which it is recorded in the books of partnership firm will be considered as the consideration. Now, if the partner is introducing his share of capital in the form of unquoted equity shares, and those are recorded at its face value, then as per 45(3), face value will become the consideration. But as per 50CA or as per Rule 11UA, the valuation should be at the method based on the method prescribed under the Act. So now the question comes whether it will be considered at its book value or will it be taxed considering the fair value as per Rule 11UA. Presently, we don't have an answer, but to my understanding, whatever I have understood with these two sections, since section 45(3) is complete in itself, it has not given any reference to any other section, and it's already a deeming section. We cannot have two deeming sections applying at the same time. If the intention of the law to have the fair value of the share, they can make the amendment under section 45(3). There is no need to again come to section 50CA or Rule 11UA. So to my limited knowledge, presently in my opinion, I feel 45(3) should prevail. But again, this is very subjective and obviously depends upon the facts of the case. So somebody may have a different opinion here. One thing more, no tolerance band provided. Thus, the fair market value as per the new formula method will be taken as full value of conversion. 50C has given 5% tolerance band. So if the stamp value is different than the value at which it is recorded under section 50C, the difference up to 5% is acceptable. But under section 50CA, there is no tolerance band provided. In case of sale consideration being less than fair market value, the seller will be taxed under section 50CA on the ground that he has not declared to consideration. And on the other hand, the buyer will be taxed under section 56(2)(10) on the ground that he has understated the purchase consideration. So for the same transaction, the buyer will be taxed under section 56(2)(10), which is under the head other sources, and the seller will be taxed under section 50CA. But one thing need to know, if the seller is holding those shares in the form of stock in trade, then in that case 50CA will not apply. It is applicable only if the shares are held as a asset. Now moving ahead, this is just a small example. So if X transfers his unquoted shares at a cost of rupees 8 lakhs to Y at rupees 10 lakhs, whereas the fair market value of the shares as determined in the prescribed manner is 50 lakhs, then in this situation, the provision of section 50CA would apply in the hands of seller, whose full consideration for computation of capital gain would be 50 lakhs. Further, Y, who is the buyer, would also be liable for the same amount under section 56(2)(10) on rupees 40 lakhs, as it is under the head income from other sources. Hence, the difference of the 40 lakhs is taxed in both the hands, resulting into double taxation. Now here comes some important illustration. I have kept it simple because we just need to understand the concept. But in my opinion, to apply these rule 11 UA is a very, very complicated process. I'll just explain you what is the background of these rules. What used to happen before these amendments, how people used to exploit the act. Before this amendment, let's take an example. There is a company, ABC Private Limited. This is the balance sheet of this company as on 31st March 2010. There are two shareholders, Mr. Sharma and Mrs. Sharma. I guess 80% of the companies, like small companies, is having this composition, husband-wife holding 50-50%. So Mr. Sharma is holding 50 lakhs worth shares. Mrs. Sharma is holding 50 lakhs worth shares. And the amount has been invested by ABC Private Limited immobile property, the total amount 1 crore rupees. The same company balance sheet in the year 2016. Now, if you can see, the share capital is again 1 crore, but instead of Sharma and Mrs. Sharma holding it, Mr. Verma and Mrs. Verma is now the shareholder. The land remains the same at its cost using the cost concept. We are not supposed to revalue it. Before the amendment, since this is 2016, there was no requirement to revalue the assets. In actual sense, by transferring the shares and that at its book value, Mr. Sharma has technically transferred his immobile property to Mr. Verma. The land probably may be having a price quite higher than 1 crore rupees. So if, say, for example, the fair market value of this land is 3 crore rupees, then technically Mr. Sharma has saved his capital gain on 2 crore rupees. If we just ignore indexation, some indexation will certainly come. And Mr. Verma is also at profit because he has saved the stamp duty supposed to be paid if the land was transferred as a land and not in the form of shares. So in this case, the company wanted to sell the land, or Mr. Sharma wanted to sell the land, but instead of selling land, he sold his shares. So indirectly, Mr. Verma became the owner of ABC Private Limited, and whosoever is the owner of this company indirectly becomes the owner of the land also. So this was the planning before this amendment, and this was done even in the smallest of the place in India. And it took so long to the department to understand this, because I feel this amendment should have taken place way back, but it came in the year 2017. Court decisions which might have triggered this introduction of section 50CA. This is one of the case with which the government realized that section 50C is not working in this particular planning, and they need to have an amendment and a new section is required. What this particular case has to say? In this case, revenue contended that transaction of shares was a colorable device and virtually immovable property had been transferred. While rejecting such argument, the High Court observed as follows. The assessee, by restoring to such a tax planning, has taken advantage of the benefit of the law or the loopholes in the law, which has ensured to his benefit. After seeing how this loophole has been exploited within the four corners of the law, it is open to the Parliament to amend the law by plugging this loophole. Finally, the government realized that 50C is no more working in this case and they need this section. And now we have this section being plugged by this loophole. This loophole being plugged by section 50CA. There's one more case. This is DCIT versus Maya Appliances Private Limited. In this case, according to revenue, the assessee sold the actual land and building in the guise of the sale of shares, and thus the section 50C is applicable. What they want to say is, by taking the shield of this private limited companies, indirectly they are selling the land, which everybody now can understand. However, the tribunal declined to adopt this argument and held that no question of invoking the provision of this section 50C of the Act, as there is no direct transfer of land or building or both, because section 50C is applicable only in direct sale. Nowhere in that section it is written directly or indirectly. So 50C will not apply in this case. So very important is written. We have one more interesting case, MedPlus Health Services. In this case, the revenue adopted the market value of unquoted equity shares, ignoring the valuation methodology given in Rule 11A. So before 56.2.10, in that original section 56.2.7 and 7A, Rule 11U was there. They already introduced that rule in that year of 2009. But they themselves mentioned that the assets are to be taken at a book value. What assessing of did is, by ignoring the methodology given in Rule 11UA, he took the value of the assets at its fair value in accordance with the prescribed method, but cannot adopt the market value as fair value under section 56.2.7A of the Act. 56.2.7A, which has now been amended, now it is no more applicable. In that particular section, the government said that in this case, book value of the asset is taken. So when the government themselves are saying that book value is to be taken, then how the assessing officer can disregard their own rule and make his own rule? So the legislature, in its own wisdom, has given a formula for computation of the fair market value, which cannot be ignored by the authorities below. So when the the government has already issued a rule where they themselves say take the book value, the assessing officer, who is a part of the system, cannot ignore the rule and adopt a fair market value. He has to compulsorily follow the Rule 11U as it was before the amendment. Now, what this new amendment has done, that we need to understand. In this case, we are now moving to the second level of planning. In the second level of planning, what we have is balance sheet as on 31st March 2010. Facts of the case remain the same. There are the shares are with Mr. Sharma and Mrs. Sharma. Investment now, instead of making investment in land directly, they have now invested into another private limited company, that is in XYZ private limited company. What happened in 2016? Mr. Sharma transferred his share to Mr. Verma, exactly same as it was there in the earlier case, and the shares remains at the same value. Now, before we discuss this, let's have a look on investment in XYZ Private Limited. That means the company in which ABC has invested. This is the balance sheet of XYZ Private Limited. In this, the capital is with ABC Private Limited, 1 crore rupees. Since there needs minimum 2 shareholder, Mr. Sharma is holding just a nominal value of 10 rupees. The company has invested into land. The share of this company remains the same. So just to explain in brief, instead of the company directly investing into land, they have now created a layer. Company ABC Private Limited invested into XYZ company, and XYZ has made the investment into the land. So now if Mr. Sharma wants to sell his land to Mr. Verma, he has nothing to do or no changes is required in this particular company, even by transferring the shares of ABC Private Limited, that means the previous, this company share, they can still transfer the to the new person. Mr. Sharma transferred to Mr. Verma. So now Mr. and Mrs. Verma is the owner of ABC Private Limited. ABC Private Limited is the owner of XYZ Private Limited, and XYZ Private Limited is the owner of this land. So now indirectly, Mr. Verma is the owner of the land. This was the second level of planning which people used to do. But the rule which now has been amended in the year 2017-18 has taken care of all these loopholes. The rule states as under, we will quickly understand what is this rule, and we will make a comparison of this rule with the rule that we have discussed in the previous section. Rule 11UA after amendment from applicable from 1st of April 2017. Fair market value of unquoted equity shares. If you remember earlier, it was A minus L. But in this rule, we don't have A minus L. We have A plus B plus C plus D. So the difference between the previous rule that we have seen, that 11UA2, and this is rule 11UA1, the difference between the two rule is the asset, instead of taking the total as one figure, has been categorized into 4 categories. I repeat again, the only difference between the rule which is given for section 5627B, that is in case the company issuing the shares, is different from this particular rule which is applicable for section 56.2.10, that is when the existing shares are being sold, the difference is the valuation of its asset. Instead of taking all the assets at value, this rule has asked for the revaluation of some categories of assets. Now, what are those assets which needs a revaluation, and how it is to be revalued has also been defined. First, we will talk about B, C, and D, and then we will come on to D stands for jewelry and artistic work. So if the company whose shares are being sold is having some jewelry or any artistic work as an asset in their balance sheet, then in that case, those assets are required to be revalued, and the valuation report is to be received from a registered valuer. C stands for shares or securities. So if the company whose shares are being sold has made investment in any other shares or securities, then those shares and securities are also required to be revalued, and the revaluation is to be done using the same rule. The rule 11UA is applied even on the investments made by that original company into some other companies. And the D stands for stamp value, that is the immobile property. So if the company has any immobile property as an asset, then that immobile property is to be read, and it is to be always and always to be taken at stamp value. They have not given any to go for its fair value. The word used is stamp value, and compulsorily only stamp value is to be taken. The registered value or value will not be accepted. Liabilities, there is no change. Rest of the things remains the same, except 3 types of asset. That means jewelry, artistic work, shares and securities, immobile property. Rest of all the assets, whether it is trademark, copyright, intangible asset, goodwill, anything and everything is to be taken at its book value. I hope this difference is clear now. The rule 7UA1 is applicable to the transaction where unquoted equity shares are being sold. In this rule, are required to be revalued. There are categories of asset which are defined only, and only those assets are required to be revalued. There is no flexibility given to revalue any other asset other than these three categories, which is jewelry, artistic work, immovable property, and shares and securities of some other company. One very important thing, the method allowed to value the shares for this particular section is only and only the net asset method. The DCF method is not allowed in case the existing shares are being sold. The DCF method is allowed only and only when the company is issuing the shares. Now we will come why I think, or why in my personal opinion, these rules are very, very difficult to implement. What are they saying? First thing, 7UA1 has asked the valuation to be done on the basis of audited financial. Just read the word what they want to say. Basis of audited financial statements as on the date of transaction. So if the shares are being sold on 25th of February, then in that case, they need the audited financial statement of the company whose shares are being sold as on 25th February 2018. Against in the previous rule, there is one more difference. I'll keep on telling you the difference so that then we don't have a confusion. In that previous rule, when the company is issuing shares, there is a flexibility given in case the balance sheet as on the date of transaction is not available. In that particular rule, they have allowed the last audited balance sheet also. But if this particular rule is to be applied, that means the first rule 1, in that case, compulsorily the balance sheet has to be as on the date of transaction. Closing the financials and audit thereof alongside the transaction closing date is practically a task impossible to perform, particularly when the transfer is happening at the instance of the shareholder. How can a shareholder insist a company to get its account audited in the middle of the year when he's transferring the shares? While for determining fair market value, in section 627B, there is categorically mentioned that if the financials as on valuation date are not drawn up, the last drawn financial statements may be referred, but there is no simple relaxation given for this provision. There should be some relaxation, but presently there is nothing. The second challenge, valuing investments held by the entity. Now what this rule is saying, that if company A has invested into company B, C, D, then in order to have the value of company A, first we have to revalue company B, C, D. And if this B, C, D in turn has made investment into E, F, G, H, I, J, etc., then before making the valuation of company B, C, D, C, E, or whatever, D, E, F, we need the chain, complete chain to be revalued. They have not mentioned where we need to stop, and they cannot, because then the tax planning will start. So this is such a hardship that if company A or company 1 has to sell, the shareholder of company 1 has to transfer the shares, and if unfortunately that company 1 has invested into 10 private limited companies, and those 10 companies in turn has invested into some 50 more companies, then in order to get the fair value of company 1, all the companies in the chain are required to be revalued, and that too as on the transaction date with the audited financial statement. This is practically impossible. Nobody is going to do. One again challenge, if there is a cross holding, then the act is silent. If company A has invested into company B also have invested into company A, then obviously in order to get the fair value of company A, we need the fair value of B, and for getting the fair value of B, we need the fair value of A. How to deal with the situation? To the limited knowledge I have about mathematics, I guess the simultaneous equation is the only possibility, but act is silent on it. So it is just we are taking it from the other acts, but presently there is nothing clearly made how to deal with the situation of cross holding. The third challenge, What if the company has made investment into foreign subsidiaries? They have not said shares and security has to be of the companies registered in India. So if this company has made investment into a foreign subsidiary, then in order to get the fair value of the shares, we need the fair value of all the foreign companies also. And then we also want that those foreign companies should make their financial statement as on the transaction day. It should be audited, and then only we can accept that particular balance sheet. This again is silent. We don't know. Next problem, and this is very practical problem, that if company A has invested into company B, and for example, this company has invested at rupees 1 lakh, but now company B, because of its continuous profit and all that thing, has now the worth has increased to say 10 lakh rupees. So 1 lakh has now increased to 10 lakh, and that is the fair value. But if company A wants to sell the shares, or if company wants to even give dividend to give that money or return whatever that investment has earned, it will come with taxation. So even though the value of that asset is 10 lakh rupees presently, but if that investment is realized, the company A will never get that 10 lakh rupees. Company A will get something less than 10 lakh rupees, at least 20-25% is going to go in the taxation. So if we take the fair value as 10 lakh rupees, technically this company is again paying the tax on the tax which is supposed to be paid on the profit which the investment may earn. So again, we don't have any answer to this situation. This is something which very interesting. 5627A and 56.210 of the Income Tax Act, it is applicable on fresh issue of shares, bonus issue of shares, right issue of shares, and buyback of shares. I'll just first, before we read to circular, why this was required. Now, when the company is issuing shares, I repeat, when the company is issuing shares, the company will follow Rule 11UA2, where the assets are to be taken at a book value. And if those shares are received by the shareholder, then for the purpose of valuing those shares, Rule 11UA1 is to be followed because he's at the receiver end. Then in this case, whether it will come with a tax implication, we don't know. Technically, it should not, because Rule 11UA2 says that the assets are to be taken at book value when the company is issuing shares. But when the shareholder is receiving shares, they say Rule 11UA1 should apply, which needs the fair value to be taken. So for the same transaction, they cannot have two valuation rules. So we don't know when the company is issuing fresh issue shares, only 56.2.7b should be considered, 56.2.10 should be ignored. But we don't know whether that is the present case. Though the CBDT tried to clarify it with a circular, the CBDT had issued a circular on 31st December 18 to clarify that provision of section 56.2.7a of the Act, being anti-abuse provision, shall not be applicable in cases of receipt of shares by the specified company or a firm as a result of fresh issuance of shares, including by way of bonus shares, right shares, preference shares, or transaction of similar nature by the specified company. However, on reconsideration, it was observed by CBDT that the matter relating to interpretation of the term receives under section 56.2.7a of the Act is pending before judicial forums, and stakeholders have sought clarification on similar provision in section 56 of the Act. Accordingly, with the idea of a fresh comprehensive circular on the subject, which is till date has not been issued, the CBDT circular number 10/2018 was withdrawn by CBDT by a new circular dated 4th January 2019. While drawing the circular, it was also clarified that the said circular should be considered to have never been issued. So we don't know whether this right issue and bonus and etc. will be covered or not. But for okay, we'll just link it with one more important thing, that is explanatory memorandum to Finance Bill 2010 explaining the rationale behind this introduction of section 56.2.7a. In order to prevent the practice of transferring unlisted shares at a price below its market value, it is proposed to amend Section 56(2) to also include within its ambit transactions undertaken in shares of a company, not being a company in which public are substantially interested, either for inadequate consideration or without consideration, where receipt is a firm or recipient is a firm or a company. Thus, it is amply clear and duly evident from the above that the legislative intent of introduction of this section was to prevent the practice of transferring the unlisted shares at a price below the fair market value. The expression transfer altogether a different connotation and meaning than the expression issuance. So when the company is issuing shares, it should not be termed as a transfer because the asset actually came into existence with that particular act. And as such, the provision of Section 56(2)(7)(a) were meant to be applicable in cases of receipt of shares by a company or a firm or subsequent transfer of unlisted shares after their initial issuance of the company. So if the company is issuing shares, even though it is issued at a book value, the receiver of the share should not be taxed because the fair value has not been adopted. This one case law will be of great help to most of you because this judgment says Sudhir Menon HUF versus Assistant Commissioner of Income Tax. It held that additional allotment of shares to an existing shareholder of a company at less than fair market value as a part of genuine business transaction should not be subject to Section 56(2)(7)(c) of the Income Tax Act, where the last line is extremely important, where the allotment is not higher than the proportion of existing shareholding. So basically, they are talking about right issue. So if somebody is having a doubt here, what if the company has given this right and some of the shareholder renounce their right and some of them exercise this right? Then will it be exempt from Section 56(2)(7)(b)? The answer to this question presently we don't have, but considering what has been given in this particular judgment, it will be taxable. So only and only if the company is issuing shares to its existing shareholder in their existing shareholding ratio, then this valuation rule should not apply. This is what has been given as per Sudhir Menon HUF case law. So if some of the shareholder has renounced their right, then probably the valuation rule will apply. This particular case law will not be of any use because the facts of the case then will differ. Now the last part of the session, what is still the loophole? I'm just again repeating the same example so that we can understand how simply by changing the instrument or the investment method, a company can save tax. So in this illustration, ABC Private Limited again having Mr. and Mrs. Sharma 50-50 lakh, but now instead of making investments in a private limited company, if they decide to make an investment in a partnership firm, then in that case, the Rule 11UA, even after amendment, will not apply. So in this case, what has happened? ABC Private Limited is having two shareholders. The company has made investment into a partnership firm, and that partnership firm, I'll just show you the balance sheet in the next slide. And partnership firm has made investment in land. So now if Mr. Sharma wants to sell his land, what he will do? He will transfer the shares of ABC Private Limited, and while doing so, nowhere in the rule he is required to revalue this partnership interest because investment in partnership firm is not covered in that B, C, and D category of asset. So it comes under A category of asset, which is to be taken at its book value. So presently, this is particularly the tax planning which is going on pan India, and there are of hundreds and 200 crores of rupees. And what common doubt probably may have come up with presently, why the government did not cover partnership firm when they understood that the company are making tax planning with this particular modus operandi, then why they did not include partnership firm? If they can include shares and securities of a private limited company, did not include the investment in partnership firm. So to my understanding, technically, a partnership firm is not a separate legal entity. It is only a separate legal assessee. So if they want the value of partnership firm also to be taken at fair value, then it will result into double taxation. And as per income tax basic rule, income should not be taxed twice. Because partnership firm and partners are one and the same, they are not separate legal entities. The valuation methodology cannot expect the partnership to revalue the shares, because if we revalue that partnership share and make it taxable in the shareholders who are transferring the shares, then again, when actually the partnership firm will sell that particular land, that land profit will be taxed second time in the hands of partnership, whereas it has already been taxed in the existing partner at the time of transferring the shares. So technically there is a problem. Because a partnership firm is not a separate legal entity, it is not required to revalue its asset, and in turn the partnership firm is not to be revalued, and a company can very much transfer its shares by taking at the price at which it was booked. So this is what presently still not covered. So the term, I've already discussed it, that the term share has not been defined in the Income Tax Act, and hence it is to be taken from the Companies Act, where it is exclusively including only and only the shares in a company and not in a partnership firm. This is all about the important sections, Rule 11UA1 and Rule 11UA2. In just 5 minutes, I will sum up because it sounds confusing. Rule 11UA1 is applicable when the existing shares are sold. Rule 11UA2 is applicable when the company is issuing shares. Rule 11UA1 requires the audited balance sheet as on the date of transaction. Rule 11UA2 does not require audited balance sheet. It can even be the last audited balance sheet also. Rule 11UA1 requires fair value of 3 category of assets, that is jewelry, artistic work, shares and securities, and immobile property. Rule 11UA2 compulsory requires the assets to be taken at its book value. I guess this is what the major difference between these two rules. I guess I'm done with this presentation part. I hope I could do justice with your valuable. We can now open the forum for question answer in case you have any question, and if I can just share something about if I know the answer.
Madam, we have questions.
All right.
Madam, we have questions.
Okay, sir. Oh.
Madam, there are a couple of questions is listed here.
Okay. So few questions I answered because that came. Yes, sir. Audible?
Yeah, audible. These questions are listed here in the question and box. The first question is under section 57(2). 7B, is a company required to value the shares under DCF method or NAV method? Do the AO has a discretion on the method of valuation?
So section 56(2)(7)(b) allows two methods, DCF and NAV. So both of the methods is acceptable, and the decision is that of an assessee. The assessing officer can ask for modification and can reject in case they find that the projections are not scientific and it's not realistic, and the assessee cannot prove it to be based on some practical assumptions. So that is very subjective and depends upon the facts of the case.
Next question is, when the company is unable to justify the projections to consider DCF method, can the AO insist on valuing under NAV method?
Yes, actually, one of the case law that we saw during the presentation, in that particular case law, I guess probably it was Bangalore Tribunal. I don't remember. Maybe I'm wrong here. But the tribunal said that in this case, when the assessee himself is not able to justify its projection, AO is left with no other option but to go with the NAV method, because these are the only two methods allowed.
Value of shares and immovable properties held by the company issuing shares whether need to value these assets at book value or fair value under Rule 11 UA.
So when the company is issuing shares, in that case, the assets are not required to be revalued. Even if you want, you cannot revalue. If you by mistake revalue it, then it will result into taxation. The additional amount will be taxable in the hands of the company. So don't revalue the assets.
Para C of Memorandum to Finance Bill 2012 covering 56 to 7B and 68 to Proviso gives a reason for introduction to prevent generation and circulation of unaccounted money. Can a company claim that this will not apply to a genuine receipts?
Firstly, the section 56 to 7A now has been done away, and the similar thing has not been given for 56 to 10. Basically, if it's a genuine case, then we have Sudhir Menon case where it is said that the clarification which was there in the notification has been withdrawn. In that case, they said when the company is issuing shares, it cannot be regarded as a transfer because the asset itself took into existence with that particular issuance. So when the asset was not in existence, it cannot be regarded as a transfer. So presently, that is what the opinion everybody is taking, and that is what the intent of the law also. So this is.
What about the contrary view taken by the Bangalore Tribunal in TUV Rainland NIFE Academy Private Limited, where the AO was found to be correct in adopting NAV method of valuation and the company was unable to substantiate the projections based on DCF method?
So if the projection, again, the tribunal are always insisting, just because you have been given DCF method, you cannot bring projection which doesn't have any basis. So if you say your small company, which is presently making a turnover of only 20 lakhs, tomorrow all at a sudden, without any contracts in place, will make a turnover of 200 crores, then this projection will not be accepted by the AO. And in that case, why they felt that 200 crore will come, they have to have a basis. So if they have some contract in place, if they have some agreement in place, their talks are going on with someone, later on it may happen that the agreement did not hold good. But as on the valuation date, if you have agreement in place, then that will be accepted. Otherwise, the AO can reject it.
What will be the status on sweat equity shares under section 56 to N?
Actually, for sweat equity shares, bonus shares, right shares, presently we are not very clear. But we need to wait for some clarification as it is just in 2017. So now onwards, we will be seeing more of the cases.
Is section 50 CA is applicable only where there is a transfer and not when shares are allotted either as a private placement, preferential allotment or by way of right shares?
Okay, section 50C is applicable firstly only when the existing shares are being sold. So if it's a private placement, it is not an existing shares which are being sold. So 50CA will not apply here. Here only 56 to 7B will come into picture. 50CA and 56 to 10 only in existing shares.
And the date of transaction may be effective date of transaction and not literal interpretation. I don't know whether is suggested or question. Valuation investment to depend on subsidiary associate company logic is not. Is it not?
So if a company has invested into companies which are their subsidiaries and associates, then while making the valuation or of the existing company, you have to always value the subsidiaries and associates first. Then only the value of the existing company can be worked out.
Okay, how about LLP?
LLP is also like a partnership firm. So LLP is also as presently not covered under Rule 11 US. So you can use partnership firm and LLP for tax plan in short.
Can you have recorded session sent to my email ID? Dear members, kindly note that all the Bangalore branch programs, we have a YouTube channel, Bangalore branch of SRC of ICI. After the program, within 8 to 10 hours, we are uploading maximum one day. will take, and our edit team is very so fast. And after also background material, whatever shared by the speaker, will be uploaded in our website under the background material link. Please note that. With that, again, next question is, for FME of assets, do we need to take into account net realizable value, less expenses and taxes?
For NAV method.
Yeah, I think he's not.
For NAV method,
FME of assets. Correct. His method is not mentioned, madam.
for NAV method, assets minus liabilities is to be taken, and liabilities should be ascertained liability. The contingent and unascertained liabilities is not to be deducted.
Speaker said about practical problems and having an audited financial as and date of transactions. Wanted to know whether effective date can also be treated as date of transaction.
Effective date is the date of transaction. So last audited cannot be taken. They have to take the balance sheet on the date of transaction, not the last audited, which is otherwise allowed in Rule 11 UA 2.
Yes, madam. That is our the questions is listed by the members. It was really an excellent session. I could say that the topic is like that very. The members are eager to listen this topic, and when you are starting with the relevant section 56 to 7a b, and again the referring the starting with the quoted the closely held companies issue shares, that is in you quoted Bangor Tribunal Innovative Payment Solution Private Limited case. Then when you come to the earlier background of section 50C, now it is after amended 50CA. You are always saying 50CA is 50CA, but how it will be affected to the chartered accountants? That is the thing.
Chartered accountants will find a way out. They are expert.
Then DCF method, yes, it is only applicable to merchant bankers can issue the valuation. But apart from that background work, whatever will be there, that is for the our profession has to do it.
Yes.
That part, and it was an really good session, madam. So around 500 members have viewed today's program also. So all on behalf of all the viewers and on behalf of managing committee members of Bangor Bank, on bottom of my heart, I wholeheartedly thank you for your wonderful presentation, madam, sharing your knowledge on the insightful, and definitely our members have got enlightened in us. Our motto is that Jnana Dasoha. Dasoha means sharing the knowledge without any expectation. That is the motto we are having for the Bangor branch. So really, it was a good session, madam. Once again, I thank you for spending your time, valuable time. I request you to write one article for the Bangor branch newsletter. Please send it. We will publish.
Yes.
We'll share to the all the members, those who are missed the today's session.
It will be my pleasure, sir. And in fact, I want to thank you because I guess so many participants have joined, and many of the participants probably may be so senior that they may be having experience that of my age. So I take this humble opportunity that I could do justice with the valuable time of so many senior chartered accountants. Thank you so much, sir, for considering me for this particular platform. It's a very, very big opportunity for me. Thank you so much.
Because knowledge they have any age limit, and they don't have any border limit. Yes, that's knowledge is knowledge, and our motto is only connecting the resource persons to the our honorable members to serve, because we are elected to serve for the members. So our duty is to connect to the extent possible the wherever knowledge hub is there. So we are trying from our side as a Bangor branch actively with support of all our members and ex officio. My wishes for the you, madam, and all the viewers. Gauri Ganesha Chaturthi is, as you know, Maharashtra. This Ganesha Chaturthi was a very, very important festival. As Bal Gangadhar Tilak, I could remember he started the Ganesha festival from Maharashtra only. I could recall that memory, and I wish all the members for Gauri Ganesha festival and stay safe and be careful about this all corona, and let's in between, because this is a pandemic time. Our duty is the our client. If any problem, if accountant is not coming, no problem. If banker is not lifting call, no problem. So they have a belief on chartered accountants. Yes, my CA will receive the call and he will 24 bar 7 always awake, and he will help. That trust and faith our chartered accountants members are having, and truly they are serving for the client. Yes, sometimes cash flow for this during this time maybe hitting for even chartered accountants firms, but our service motto should more stronger and more elaborately. We have to serve for our clients in this difficult situation to overcome this all even economical conditions also. I also thank all the viewers for your active participation for the today's session, and I wish you all for also happy Gauri Ganesha. Dear members, I as initially told, the next our session is on 25th August. It is on penalty under section 271 double AD, a new POR 26 years is going to address by Naveen Kariwal. And after that, we had two tax edit sessions. We don't know when again we are expecting tax edit date, maybe get extended, but our duty is that we have to be make it for the companies as early as possible. We can comply this tax edit provisions also. With that note, once again, my special thanks to the today's speaker, CA Premlata Daga madam, for spending the time. Thank you, madam. I thank all the viewers for active participation. Thank you, one and all. Have a good day.